so it looks like the attendee count is starting to slow down just a little bit. We want to get started with the second quarter macro markets conversation today. We have a couple of folks that are on the line and going to speak to the content that we're going through and the conversation that we're having. So you have myself, Chris Maxey, Chief Market Strategist, Brad Long, our Chief Investment Officer, as well as Dimitri Katz-Nelson from our individual wealth business. What we want to do as we go through the conversation today is really talk about all of the things that have been happening since beginning of the year, recognizing that there is quite a bit to unpack. So if we go back to where we were on January 1st and fast forward to today, April 23rd, there are quite a few events that have taken place. And as I'm sure everyone has seen, or I would imagine everyone has seen, it's happening in all facets and all corners of the globe, whether it's geopolitics, it's artificial intelligence, and the impact that that's having on the broader stock market. We're also seeing quite a bit of conversation around AI's impact on labor markets, and we'll do our best to go through all of that today and try to unpack the trends as we often do. So, Dimitri, if you want to step forward just one slide, we'll show everybody what a short, strange trip it is. It's been year to date. Normally, we talk about the long, strange trip, and yet this year it's only been 4.5 months, and it's been a short, strange trip. You can see whether you're looking at the S&P 500 or you're looking at the ACWI ex-US index. So for international stocks, that's that blue line. We had a very strong start to the year, particularly overseas, where you had international stocks that were up over 10%. And you can take a look at all of the events that have happened and transpired since January. And then it was very quick that as we came and turned the calendar into March, stocks began to sell off, and those all-time highs quickly disappeared. Just a few short weeks later, all-time highs were back, and markets were acting as if not a whole lot had happened. Although I think we are all quite aware that a whole lot did happen. Now, the key points, Dimitri, if you want to go back just a moment, the key events that I would highlight. One, Kevin Warsh was nominated as the new Fed chair. That happened in January. We're seeing that conversation around his appointment is ongoing. There are a few things that are going to hold up that appointment. We're not going to have an opportunity to talk about that today. Nevertheless, that transition is scheduled to occur in May. And that's a very key development to watch over the next couple of weeks. The other thing was that the Supreme Court struck down an existing set of tariff policies in the middle of February. That did not apply to all tariff policy. That was a subset of about 100 billion of total collected tariffs to date. And what's important to recognize or understand with regards to that decision is that the effective tariff rate will come down, but it will not go back to where it was predating the current administration, so predating the Trump administration. The expectation right now is that tariffs will go back to around 10% on an effective basis as we look out over the next 4 and 6 months. And that's in part because the temporary measures that were put in place after the Supreme Court decision are going to expire. So as you think about the implications there, one of those is that there's a bit of an easing in terms of that tariff policy and the restrictions that were in place. And that's overall a bit more supportive for economic growth. It's supportive for corporate decision making. And that's, again, one of the levers that has brought the stock market back towards all-time highs. And now that brings us to what took place at the end of February and coming into March, which was the war that broke out in the Middle East. I'm not going to spend as much time on that conversation because we do have a portion of the discussion dedicated to that a bit later on. Nevertheless, I think people are going to be generally surprised that war breaks out, oil prices go above $100 a barrel, and the stock market has found itself back to all-time highs. Today, there was some give back as there's still a bit of tension in the ceasefire conversations and negotiations. But part of the point here, and one of the ones that we've made a lot, is that as you're thinking about market impacts from geopolitics, you always have to be a little bit careful because the market has a tendency to look to the other side of the geopolitical event. So the market often looks to what are the fundamentals, and that's what we'll talk about today. So, Dimitri, if you want to step forward a slide, one of the key developments developments that we need to keep an eye on, and I think this is really important right now, is that the labor market is beginning to stall. And that happened around April and May of last year. So right as tariffs were being implemented and we saw that tariff rates were escalating and rising at an ever faster pace, overall hiring began to come out of the market, and companies said, look, we're not so much interested in adding to our workforce. A couple of people are attributing this to potentially impact from artificial intelligence and what that is doing to hiring intentions. We don't quite yet think that's the case, and I'll tell you why in just a moment. But if you take a look back going to 1951, fast forward over these last many decades, this is the first time that we've had a labor market that is not growing, and yet the economy continues to expand. So we continue to see that real GDP growth is growing at around 2 to 2.5%, and yet the labor market it's not growing itself. That's a very unusual dynamic because traditionally, as we think about economic growth in the U.S., it's very much dependent on the consumer. Consumers represent about 2/3 or 60% of overall GDP and of that economic growth. And if we have this moment where labor markets aren't growing, you would raise the question of, well, isn't that going to impact the economy? Now, I want to go back to a reference that I made on the prior slide, which is that now we are beginning to see effective tariff rates go lower. So as that has happened starting in the fall of last year and now carrying through to the recent Supreme Court decision, there's a little bit of a sign that labor growth is coming back to the market, and that started last month. We'll see where that heads over the next couple of months. Now, I do want to go through a bit of a narrative busting exercise here. So I mentioned the words AI, and oftentimes we jump to the conclusion that AI is going to impact the labor markets. It's going to hurt software companies, perhaps. It's going to hurt a lot of traditional businesses and white collar jobs. Well, I want to show you the potential contrary to that argument, which is right here. On the left-hand side, you have the Indeed job postings for software developers. And on the right-hand side, you have the overall number of workers that are in the computer industry. So two different things happening here, but I'll tie them together for you. When you're looking at the job postings on the left-hand side, there was a very substantial ramp up in the years after COVID. So the index there starts at 100, which was February of 2020. That's your baseline starting point. All the numbers thereafter are really just a reflection of above and below. So what happened is that there was very strong hiring in the years after. We jumped up to an index that was 2.5 times what it was in February 2020, meaning that the job postings were about 2 times as prevalent before they started to come back down in the years after. What we're now seeing is that over the last 12 and 24 months, job postings are on the way back up for software developers, though we see that the number of workers within the computer industry is coming down slightly. So what's happening? Well, as we think about our business and the incorporation of AI and the things that we're doing, we would love to build a tech stack internally, straight from the ground, using AI and all the tools that are available. But the reality is that as much as Brad and Dimitri and I have great vibe coding skills, we don't necessarily know how to build the best portfolio management software. We don't necessarily know how to build a piece of software from beginning to end and make sure that it's viable. So what are we going to do? Well, we'll actually look to hire software developers. We'll bring people in-house that have that skill set and that capability. So as you're thinking about narratives and impacts from industries like AI and the evolution there, you have to recognize that perhaps what's happening is that we're having an evolutionary and a transitionary moment, more so than an existential one that is calling into question the software development business, for example, just to use that as one example. So the other thing I want to talk about is inflation and what's going on there. We, as everyone may have expected, are seeing a pickup in inflationary trends over the last 30 days in particular, the last 45 days, and that is coming from higher oil and energy and gas prices. What you'll see is you look all the way over there on the right-hand side is that pickup, and that composition underneath the pickup is a function of services, but also food and energy prices having risen and gone higher. Now, a couple of things that Brad had pointed out to me as you're looking at the categories is one of the items that you can do is break down the subcomponents of inflation from those that are rising by more than 3%, those that are stable, if you will, between 2 and 3% increases year over year, and those that are falling. We have a little bit of a tension where things like used car prices are coming down. So if you were thinking about going out and buying a car, or you were interested in perhaps buying a car for someone in your family, now looks like a better time than, as we all recall, in 2022 when those prices were jumping month after month after month. But when you're looking at the food price increase, you're looking at the price of energy increases, they're there, they're pretty substantial, but we're also seeing medical costs are going up. So what we've always guided towards is, as you're thinking about inflation, everybody's individualized basket is different and it's unique. So my experience is going to be a little bit different than yours. So as much as we talk about inflation as this one homogenous conversation, the only real piece of inflation that all of us have a tendency to feel is food and energy. And why is that? Well, as much as my body tells me I don't need to be eating because I should probably lose some weight, the reality is, like, I'm still going to have to eat at breakfast, lunch, and dinner. So all of us are going to feel that impact, but it's that services component that you'll notice is going to be a different basket and different composition. So affordability is on the minds of politicians at the moment. It's also on the mind of voters in the lead up to the midterm elections this year. And I would imagine you are going to hear a lot more about that over the next couple of quarters and trying to bring that impact back down. So speaking of price and inflationary impacts, I want to hand over to Brad to talk about what's going on in the Middle East and how we can try to frame that and think about its impact the next few months.
All right, so let's talk about the boogeyman of affordability, which is obviously in the energy sector. So it's probably to no surprise at this point that the U.S. and Israel engaged in military action starting February 28th in the first quarter. As Chris outlined, right, we had a great start to the year. We had a reversal in March. Now, as we look at April to date, markets would be telling you, hey, we've resolved this. Here we are. We're back into the races. We would count that as maybe a little overdone. There's a little bit more wood to chop here. On this slide, we are not going to read through all of these things. It's really more of an outline to say there are a number of factors that still exist and differences between the U.S. and Iran in seeking, a peacetime resolution and materially opening and reopening the strait. If we pull back from some of the details that are listed here and think about the preconditions that we need for resolution. So first is these two parties, whether it's U.S. and Israel or U.S. and Iran, need to get together and literally meet. They have to have a conversation. They have to have a principle framework of how to bring resolution. Next, then you have to actually put meat on that bone, right? You have to build specifics around what will it mean for those principal resolutions. So, for example, uranium enrichment, that is not going to be black and white. The U.S. is probably going to say it's actually enrichment suppression and it's for 15 years, and they'll make exceptions for medical isotopes and all sorts of things, right? So you have to build a lot of context into that conversation. Those two things, there's been a lot of fits and starts, right? Either literally sitting at the table and negotiating and putting meat behind on the bone. The problem, though, as we view forward and why this might persist for a bit is around implementation and follow through. So if you remember early days in the military engagement, a number of military and government leaders of the Iranian government were killed. It's created more factions across Iran. Their ability to actually uphold, these agreements that principally, hopefully, will come to resolution might be in question. And so there's a chance we're going to be living in a period of time here where oil might be higher. And so to Chris's point on myth busting, we want to spend a little bit of time on actually kind of picking under the hood and saying, okay, with higher oil prices, what does that really mean? What does it mean for us as consumers? What does it mean for the economy? And how is the economy positioned to withstand that, most importantly, going forward? All right, so myth number one, we'll start with kind of facts over feelings. First, it's important to recognize that the U.S. is a net oil exporter. We are the largest exporter in the world. So that might be even just a new fact for you. But beyond that, as you look at this actually exponential growth here in oil production with the advent of fracking, in the really early 2000s, we might sit and pause and say, wait. So if the U.S. is a net exporter, why do we need foreign oil, right? We're already sending oil offshore. there's a little bit of nuance when it comes to actual energy production, and the things that we use in the energy world. First, every barrel of oil that comes out of the ground is not the same, right? They actually, you can break it into two different factions. So density, is it light or heavy? And then sulfur content, is it sweet or sour? The US unequivocally, for through shale production, has an overwhelming majority of light and sweet crude. Now, light and sweet crude is really effective at gasoline production and jet fuel efficiently. So those are areas of the market where we're a little bit more insulated. But that's not the only thing that comes out of oil, right? So heavier yields, things of sour and heavy yields, those produce things like diesel, asphalts, petrochemicals, which go into plastics. Like, I don't know where you are right now, but look around. Everything around you has some form of plastic in it. And so the US is a net exporter, and that's a new trick for us. It was Obama's second administration where two things happened. One, we legally allowed US producers to export off our shores. And two, we had enough excess capacity through fracking for the ability to do it. So we're sitting here and we say, well, if we're a net exporter, why do we need foreign oil? It's because we need some of these other unique components, specifically heavy and sour, to produce things like diesel, asphalt, petrochemicals, etc. So myth number two. All right, so now we know we're a net exporter, but we do import some oil products. So if you were to poll Americans, we have a poll here from 2025. It says, where do we get the majority of the oil from outside of the United States? And if you drop that in there, it's Saudi Arabia. Overwhelmingly, American citizens would say, hey, I'm thinking back to the 1980s, right? Saudi Arabia is a big oil producer. That's got to be where we get most of our oil from, right? No. So, fact, myth busted number two. Most of our heavy and sour oil actually comes from Canada or North America, Canada and Mexico. So, our northern and southern brethrens, that's where we're getting the majority of that. Again, that's helping us produce diesel and these other grades. So, as we think about our dependency on the Middle East, right, we're actually a little bit more insulated. Now, here's the next question that we're getting, right? So, wait, we're a net exporter. Wait, okay, I get it. We actually do import a little bit, but where we import, it's from Canada and Mexico. Why is it that foreign oil is really driving my gas prices higher, my food prices higher here? Well, it's because oil is a global traded fungible commodity, and it's priced on the margin, marginal increase supply, marginal increase in demand. And so if you think about a US producer here, they are going to not give a US consumer a discount and just sell a barrel of oil cheaper here in the US. If they can trade it and get it on a rail, a marine ship, or a truck, and get it to the coast and send it to Europe or Asia for a better price, they're going to do it, right? So the US, while we are insulated, right, we are not energy independent. And so, we do have oil prices and gasoline prices and jet fuel prices that are rising here now. But before we cry the boohoo or woe is me, it's important to recognize the impact to us has been far less acute. So if you look at WTI and Brent is the oil equivalent abroad. It was up 67 or close to 70% to peak. Here in the US, it only rose from end of 2025 to peak about 40%. So, being insulated is not the same as being immune. So we have a little bit of insulation, but not, total independence. Now, let's take this down to the next level, not just energy, but how does this actually influence the consumer, us as individuals? Now, going back to the 1960s, a high percentage of our wallet share was spent on food and energy. And so Chris is like, yeah, I got to eat breakfast, lunch, and dinner. And that's true. And there's a big behavioral element. And, we'll mention that in the midterms as we talk about affordability. The price at the pump does translate to votes at the poll, but the impact on your wallet is not nearly as acute as it once was. So back in the 1960s, it was about a third or 27% of overall wallet share by an individual consumer spent on food and energy. Fast forward to end of last year, it's about 10%. Now, that's come through decades of productivity and efficiency gains. Think on the food side, mechanizing farming, cold chain logistics, the US revolution of shale, right? The ability to pull more oil out of the ground. All of those things materially influenced the fall of this as a US consumer. Now, if we translate this out of consumption and into the market, we actually also see a similar pattern, right? So the OPEC era, 1980s, the energy sector was about 30% of the S&P. Today the energy sector is about 3% of the S&P. By context, ExxonMobil was the largest company in the United States at that time. NVIDIA is now the largest company in the US. And for additional context, NVIDIA alone, the market cap is larger than the entirety of the S&P sector. So it's not to frame this in that energy shocks are not harmful. They are. They hurt everyone. And, I felt it. I have a SUV and two little kids. Like, picking up and filling up our car is expensive and more expensive than it used to be. It's just not as harmful as it once was. So if we, fast forward here and we talk about the economy. So how is it that the economy is positioned to weather this period of potentially higher inflation or what might happen to demand destruction? And the punchline is we're in a pretty good spot. So this is the Bloomberg Economic Surprise Index. It measures upside and downside surprises relative to consensus. And so the more this line is rising, the more the economy is outperforming our expectations as investors. The thing that's been pushing this needle up has been the retail sector. The retail sector has been the largest single contributor to the growing economy. And if we fast forward to the next slide, it's because retail has been spending. We as consumers have been spending. Now we can get into a K-shaped economy and who's spending and where is the spending taking place. But in aggregate, there's no question that real spending on an inflation adjusted basis is growing. And there's some optimism on tailwinds, right? So OBBB, Chris, you've been talking about this for months, is now putting a lot more money in the pockets of investors. Tax refunds, food stamps, Medicare, Medicaid, student loan payments, those are all coming due and landing in bank accounts as we speak. So if there was ever a period of time in which we could sustain higher gas prices, now is a good time to do it. But it is a shot of adrenaline. Eventually, that tax refund fades. And if oil prices are still higher in the coming months, obviously consumers will be less than enthralled with that change and obviously might be reflected in polls. Now, it's not just retail. If we look at on the manufacturing side, we also do see positive trends to be able to sustain this period of time. So U.S. manufacturing up most since March of 2022. Services, it's really coming in new orders, which is a good indication and really a downstream effect of that retail sales. In order to sell people stuff, you got to order new goods and put it into finished products. And then Chris had mentioned it before, the tailwind here on the manufacturing side. Effective tariffs from October of last year, around 11%, have fallen all the way to 7%. Now, we don't think that that trend will continue or that they will completely dissipate. It's not if tariffs, but how tariffs. So they'll likely rise maybe off that 7 bottom, but they might not go all the way back to 10. And that tends to be a tailwind here for the economy. So you wrap all this together, a couple of main things to consider. One, there is a bit of a shot clock here on resolution to the Iranian conflict. We do think that there is a plausible path towards resolution. DK, if you go to the next slide, it will help kind of in this period of volatility where we might have, concerns around economic stagnation with higher inflation and a slowing economy. The robust economy will, is more likely to help us carry through. Now, that shot clock is also on the political end of the spectrum. Chris mentioned, we've got the midterms coming up, 10% of Congress not seeking reelection. If we have $4 or $5 price of oil at the gas pumps, that's not likely going to reflect well in the sustaining party and keeping majority House and Senate. So we'll see how that rocks over. So we think we're in a good spot to maintain the current trajectory, but there's a little bit more wood to chop here on resolution. So, Chris, I'll turn it back over to you and we can get into really how the equity market's been evolving with that, both in Q1 and then, into April, which has been quite the bounce.
Yeah, thanks, Brad. So I appreciate that framing and conversation around economic strength continues to be there, but we have to be cognizant of this geopolitical risk that is continuing to build and remain something that I don't think is going to disappear all that quickly. Yet there is that path you mentioned of a potential resolution. So what we want to talk about and thinking about in terms of the stock market and what has happened year to date, If you take a look relative to last year, markets were really led by international markets. So international developed and emerging markets, those were the two strongest pockets of the equity market, followed by U.S. large cap and then small and mid cap companies in the U.S. Bond market did very well last year, in part because we were able to capture our coupon. So we captured those interest payments throughout the year from January to December. And then there was a little bit of a decrease in interest rates, which provided some boost on top. Now, in thinking about the stock market, you're looking at year-to-date performance through March 31st here. If we then jumped forward 3 weeks after that, well, all of a sudden you would have seen that emerging markets were suddenly up 15%. And we saw that there was a very strong recovery in US markets, small cap companies doing particularly well, international stocks doing well. So it's just showing how fast moving the situation is and the market is responding at the moment. What I do find interesting, at least currently, is that there was so much conversation about the Mag 7 over the last 5 years. And as you look at the S&P 500, it's no longer the de facto winner. So as you look at that year-to-date performance of down 4.4% through March, the Mag 7 is not the only game in town any longer. And this speaks to why we diversify portfolios and how we've thought about incorporating more in the way of international stocks, whether developed or emerging markets, but how we've also added in mid and small cap stocks over time. Because as we've had that cyclical push on the economy and as we've gotten economic growth to come back, that has been supportive for other parts of the economy. It's no longer just a story about the Magnificent Seven. So I want to tie back into the geopolitical conversation for just a moment. We have taken a look at a number of different episodes, whether September 11th, the Brexit vote, looking at the Iraq War and the Iranian conflict and the Gulf War, and tried to aggregate up in what's admittedly a very busy chart here, but that's somewhat busy by design, to show how does the market start and then how does it finish after 400 trading days. And what you'll notice is that there's no obvious path throughout each of these events. So what I would point out and highlight for you is that as we're thinking about the end result, if you just take your eye and look all the way over to the right-hand side at day 400, what the market returns to is the fundamental economic backdrop and the earnings picture for corporate America and for businesses overseas. Now you can take a look at the bottom line there, which was the September 11th attacks and how the market evolved. Well, the market was down at that time because we were also coming out of the tech bubble, and that bubble was still deflating. It wasn't so much an issue about the broader U.S. economy. We had a very brief recession there. However, it was because the market was in a bubble and that bubble was deflating. And so the similar guidance would be shared this time around. You've got to think about the fundamental picture for the economy, but you also have to think about what it is for stocks and earnings growth. And we'll take a look at that here on the next slide. Oh, before I jump into that, I neglected to mention we are also thinking a lot about the impact of AI. And AI's impact has been no more prevalent than in the software sector. So there's two things that you're looking at here. One is the valuation multiple for the S&P 500 software index going back to 2021, and then the S&P 500 itself. Software stocks traded at a roughly 50% premium to the broader market for the last 5 years. And it has only taken 6 months for that valuation premium to completely disappear. So again, as we're talking about fast-moving markets on the geopolitical side, the same thing is happening with regards to AI's impact. So AI, a number of different companies were rolling out enterprise solutions at the beginning of February directed towards CRM and HR businesses and financial services. And we saw it happening industry by industry by industry. And that software premium has all but evaporated. Now, as I reflect back on that conversation we had earlier, we don't think the software business as a whole goes away, right? It's very hard to imagine that all of those pieces of software that we're using, whether in our phones or on our computers or our tablets, are simply just going to disappear into an AI chatbot. But the premium that was once there is being called into question because of things like how many users do you really need for a given piece of software today relative to what you might have needed 1 or 2 years ago. So this narrative will continue to evolve, and it's one that has somewhat surprisingly, not been that impactful to the market. So at the same point that those valuation premiums came down, the S&P 500 at that time was in a drawdown that was measured in the low single digits. So I think this tells you one of the really unique elements and parts of the US stock market is that we have such a dispersed number of sectors and really best-in-class businesses that are able to provide a bit of insulation, if you will. Now, I do want to talk to that same point, though, about the earnings picture. And what we're showing you here is the earnings growth or the earnings per share expectations for large, mid, and small cap stocks. So the S&P 500 is the large cap index, and then the mid cap 400 and the small cap 600 give you a representation of 400 and 600 companies within the mid and small sector. And you'll notice that that orange line up top for the S&P 500, it's inflecting higher, and it's inflecting higher by a pretty recognizable amount. Why is that? Well, Brad talked about the strength of the consumer and that consumer spending is still happening. But the other related part here has just been the amount of spending that is going into digital infrastructure. So meaning things like data centers and all of the necessary construction and build out that happens for data centers, the amount that Google and Facebook and Meta and Tesla and every other company are having to spend to continue to compete and remain competitive. That is a big component of what's happening at the top end of the market. But you also see for the orange and the blue lines that growth expectations are picking up, and that's in part because economic growth is picking up. So we're seeing that for smaller companies that there is this belief in this expectation. They are going to participate in that economic rebound that's happening, which for a couple of years there, smaller companies just simply weren't doing as well. Why was that? Well, it's because interest rates went higher. So as interest rates went higher, those companies have a bit more debt on their balance sheets, and that acted as a headwind to their profitability, to margins, and it created a bit of margin pressure. Now interest rates are coming down, economic growth is picking up, valuations are lower, and that creates a positive tailwind, if you will. The final part I'll mention, which just doesn't get a whole lot of conversation for whatever reason, is the size of buybacks that are happening in the US and around the globe. Right now, the forecast is that buybacks in the US are going to top $1 trillion in 2026. So there's going to be $1 trillion of shares that companies are going to repurchase of their own stock and effectively retire or bring out of the market at the very least. That number represents about 1.5% of the total S&P 500 market cap. And then you have an additional dividend yield on top of that of about 1.2%. So when you're thinking about why does the market keep going up despite all of these negative issues and headlines that I read about? Well, part of it is that companies are buying back a lot of shares. And there's a fundamentally stronger story in terms of the economic outlook that's hard to disconnect from all of the headlines that we're reading, but it is happening. So share buybacks of over $1 trillion, that is a remarkable number, and it really speaks to the strength and confidence that corporate management is having in their individual business prospects, as it were. So I'll wrap up, and then Dimitri will talk about what's happening in the fixed income market before we take any questions. The wrap up is one: corporate profits remain at all-time highs. We see it within the largest companies in the U.S., but we also see it as you begin to look overseas. Profitability is higher for developed stocks overseas. It's higher in emerging markets. It's a global phenomenon that's taking place right now. Buybacks are another very strong point of that fundamental picture. You have profitability at all-time highs. Companies are generating a lot of free cash flow, and they're deploying that cash flow through buybacks. The final part is thinking about the earnings picture. And right now, the earnings picture says that we are going to have in the first quarter of this year potentially 15 to 20% earnings per share growth, which would be the highest since 2021. And that's coming through a combination of different reasons. One is AI, two is strength of the consumer, three is that buyback component, which is reducing the number of available shares. But as you put all those things together, it tells us that despite valuations being high in the US, there are still enough fundamental reasons for high valuations to remain high for a long period of time and for the foreseeable future. So I'll leave it there on the conversation for the stock market and what's happening. And Dimitri, if you want to walk us through the bond markets, that would be great.
The land of bonds. Thank you, Chris. I have 5 slides, and I'm speaking to all of you loan sharks out here. Everybody, most of our clients have some level of cash and debt, means you're lending somebody money. So we're going to discuss this in the context of people paying you back. So let's first and foremost, we have to touch on the Fed. Um, Chris and Brad touched on this earlier as far as what's happening with the economy, what's happening with inflation. All of those things come to a head as far as what the Fed can and cannot actually do. And when you have a robust economy and when you have inflation that's a little sticky, you leave the Fed in a position where they cannot aggressively cut interest rates. So this chart here is showing you from the beginning of the year through today, market expectations for a Fed cut at the end of 2026 and also by mid 2027. And for a while, up until the war escalated, markets were pricing in 2 to 3 cuts here in the next 18 months. We're back down to 0 to 1 cuts, right? And for that to change, we'll need to see inflation come in a little bit. We'll also need to see employment weaken. Since we're not seeing that, markets are expecting less cuts. What does that mean for you as a lender? It means you're going to earn more on your cash for a while longer, right? Those of us still remember from a few years ago, cash was yielding you nothing, bonds were yielding you a little bit above that. As a lender, higher interest rates are not the worst thing in the world. They're probably pretty good. It's really a question of how long can we keep interest rates at this level and keep economic growth going? And for now, the answer is market thinks we can keep it for a little while longer here. So once we get past the Fed, let's talk what's actually happening to bond market performance. And Chris mentioned this on the stock side, which is through March, things looked quite negative. And here in the first 3+ weeks of April, things have changed. Things have changed in the bond market as well. So one thing you could, if you look through year to date for bank loans and high yield and ag, you were flat to down through the end of March. You're now up anywhere between 0.5% to north of 2% across these same subcomponents of the fixed income market. What's happened? The 10-year Treasury, I think, started the year at, what do I want to say, 4.15. It got down to 4 at one point, popped to 4.40. Now we're, I think, right around 4.30. So interest rates started to come back down in April. That's helped some of these markets recover. You've also seen spreads stay remarkably tight. That is actually a negative for the lender. If you're a lender, you want wider spreads. You get paid more for lending to somebody who's got more credit risk. Spreads have stayed fairly tight, have tightened back up here in April. So returns are 0.5% to 2%. We really are in coupon clipping territory. We'll touch on that at the end. But thus far, year to date, performance in the fixed income market's been reasonably normal. So getting to the other part of normal, we have more normal. I'd say this is a chart showing you yields in the muni market. And we talk about them as the tax equivalent yield, right? What is the yield on a 10-year muni relative to a 10-year treasury? And obviously munis are tax advantaged. You'd expect them to under yield, but you don't want them to under yield by too much. So this chart is showing you 1 to 2 year munis, 17 to 22-year munis, all the way out, and what those yields are relative to comparable treasuries. And for a while, muni treasury ratios were not that compelling. It was probably about a year and a half and change, and a lot of 2025, where we were telling folks that if you're in max bracket, munis make a lot of sense. If you're still in a moderately high bracket, munis made sense. But if you are now approaching 28 to 29% tax bracket, you may have been better off in more taxables than munis, or muni exposure would have shrunk a bit. We're actually back to approaching averages, and these are averages going back the long term. It's not the averages over the past few years. So that's a net positive. If you are a muni investor, you are lending to your, to your state, to your cities, you're getting your yields there are now getting to what you would expect relative to treasuries. That's a net positive for those of you in munis right now. It's definitely a net positive for those of you newly allocating to municipal bonds going forward. So last slide before I get to the summary is we've touched on munis and taxable. We want to touch on private credit. we could have a completely separate call on private credit, given the amount of questions we've gotten on the topic. And we've written a fair bit, and hopefully you've seen some of the things we've put out on the topic. We wanted to bring it all kind of to one page to discuss why all of the commotion. So there's a lot of text here. I'll focus your attention on the chart. Chris has mentioned what's happened in the software sector, where software was trading at 50+% premiums to the broader S&P, and that's come in pretty significantly here in the last 6 months. The concerns in private credit is that private credit is one of the larger lenders to software companies. So if you look at this chart on the right, it gives you an idea of like if you're looking at the broader high yield sector, how much of that is software? If you're looking at the European high yield sector, and then you look on the right, and that's the broadly syndicated loan market, right? Those are things that you can they're CUSIPed, and then the private credit market, and those are the areas that have a lot more software lending underneath. So the immediate response is, oh my God, these companies are going to zero. People are pulling money out of private credit. The reality is, and it's written here, is that software is not a monolithic sub-industry. There are a lot of operators that have significant pricing power and are leveraging AI to become more profitable and better at what they do. What we're seeing AI do is really start separating businesses that have moats, right? The gap between ones that are going to benefit from AI and use versus ones that don't. And that's going to take some time to play out. What you're not seeing, and this is where it's looked at, you are not seeing a significant pickup in defaults across software or elsewhere in the broadly syndicated space. And though you are seeing these headlines about closure of funds and things like that, a lot of those loans that were in the journal in Bloomberg have been getting sold at near par at pretty low yields in massive amounts. We saw a transaction of $400 million book. There's others. So these there's still a lot of headline risk here, and there will be risk as far as some companies will default. You would expect that, but this presumption that all of software will default tomorrow and not pay is just really not happening. As a lender, you're getting paid. And as a lender, the vast majority of what we recommend to clients, you're getting paid in cash. You're not getting paid in kind interest and otherwise. So a lot more to come here. Hopefully you've had a chance to read some of the things we put out there on private credit, but we wanted to end there before getting into the summary. So summary, near-term path, interest rate cuts from the Fed, likely off the table. So you're clipping coupons. It's an archaic term. I don't remember. Actually, I should look up when was the last time a bond actually came with a coupon book attached to it. But you're clipping the interest. That's what you should expect from your bond portfolio going forward. And largely, we are a lot more investment grade than not. There's a lot less default risk in the average client portfolio. Munis have become a little bit more attractive, not sell everything and buy all munis, but a lot more attractive than we've seen in the past couple of years. Inflation, something a lot of you have seen portfolios is the use of tips or inflation hedging strategies. Markets are pricing in increased inflation risk right now because we're seeing it. But over the over the next year or so, but over the next 5 or 10, markets are still pricing in, call it 2.25, 2.5 inflation. So depending on where you land, and if you think inflation is going to be above that, there's some benefit to inflation hedging securities. And back to the last piece, which is satellites, private credit, we think about as satellite, right? These are parts of the market where there is some risk that you're not going to get your money back. This is part of the market, at least in the public side, is really not showing signs of stress. The bank spreads in high yield, spreads in bank loans, which are again 20+% software, are really at historical tight levels. So the managers that we tend to use here have flexibility, and they're not backing up the truck and buying all credit and doing what we think is the prudent thing. So hopefully that covers all things bond. Mr. Maxey, I get to pass it on to you for Outlook, and then we can hopefully answer some questions.
Yeah, thanks, Dimitri. We had a couple of questions come in that I think are going to be helpful in informing a few things that we didn't have a chance to talk about. But before we get there, in terms of the market, the economy, and the international events that we need to pay attention to, one is that some risks are moving into the background. So potentially things like the labor market, as we discussed, that's seeming to become less of a risk right now as there's a re-acceleration of the economy, and there's been a slight re-acceleration of potential hiring, and that's a bit of a short-term window, so I don't want to put too much into that statement. But the geopolitical risk is still there, and that road forward is going to be a complicated one. Earnings growth, though, is the thing for investors to pay attention to, and as earnings are growing more than 15% year over year, that is a very strong proof statement of the fundamental picture, and it's a strong proof statement of the momentum that the U.S. economy currently has. Dimitri talked about the fixed income story and bond yields stabilizing there. We've seen some periods of episodic volatility, but overall bond yields have been relatively stable, and we like that blend of fixed income relative to the equity risk allocations, particularly as valuations have been higher, and it's a nice counterbalance to put the potential risk taking within portfolios. Globally, though, what I will share is that diversification is really important right now, because so many things are happening and transpiring at very short intervals. It's hard to reinvigorate a portfolio or rebalance a portfolio, I should say, in when a market is down for 5 days and then all of a sudden gets right back to where it was after 5 days. It's quite difficult to do that. On the economic event front, all I'll mention is that the Federal Reserve is going to be on the docket for May, and then we very quickly shift gears to the midterm elections. It's around this point of the year where midterm election conversations really start in earnest, and the conversation will be around affordability, like what was mentioned earlier. So let us get to the Q&A, because I know we have a few questions. Dimitri, if you want to turn the presentation off, we can address those. So Brad, one of the things that I think people will notably take away from our conversation today is that we're a bit more positive and optimistic on overall fundamental picture, but there of course has to be a bear case out there. Are there are there things that do give us pause about what the go forward is for either the market or the economy?
Yeah, if you cannot see the other side of the equation, then you can't see the equation, right? There's always components of this that are bullish and bearish. The ones that are fairly obvious, I think, out there, we've discussed some of them, and are optimistic about resolution, but you could easily paint the other side of the coin. Geopolitical escalation, I think, is one. You get an expanding military conflict in the Middle East. That knocks on to greater inflationary pressures. You could have that expand into kind of Europe and more particular. One could argue that Israel and specifically the US's engagement in Iran is a proxy war for China, right? It's also Venezuela and Cuba and others. Could you have expansion there? I won't even bring up kind of China, Taiwan, because that's a red button that we don't think anybody's going to push. But one could take a logical extension there. Now, again, we feel like most of that there is lots of opportunity and lots of motivation to seek resolution and path towards that. But obviously, you could see where the other side of the coin could move. The second, as we look across markets, we mentioned valuations. Valuations have been compressing recently as earnings, Chris, as you mentioned, have been accelerating, and price had taken a dip in March. But all else equal, valuations are still fairly full. The S&P trades around 20 times forward 1 year's earnings. That's on the upper limit of what we've looked over the last 20 years. If you just take the simple math, all else equal is higher valuations is lower forward return expectations. And so navigating that market, it comes back to exactly what you mentioned just a moment ago. Diversification, both within assets, either international, small cap, et cetera, or across assets, fixed income, is important. And then it's easy to forget that the events of February 28th kind of erased our memory just before that in earlier February, where it's seemingly AI was eating the world. One headline at a time, AI was coming for the sector in which you or I work, and a lot of stock volatility was associated there. We don't know, and no one really does, what the future of AI will hold for the market, for labor, for opportunities. But it does, put a little bit of fog in the mirror or in the crystal ball of what the future holds. All else equal, we do believe that AI is going to be an augmentation and enhancement to productivity for labor and be beneficial to society overall. But it's unlikely to come in a kind of perfectly manicured process in which there's no disruption if that ends up being true. So we'll have to take that as it comes, and it's going to be distributed differently. So there is plenty that you could put on the worry list. Those are things that candidly we're paid to worry about. We ask ourselves those questions all the time. But there are pockets of exuberance. And maybe, Chris, I'll turn it back to you. One of the things we've been... Oh, Chris, you're on mute.
Sorry, before you do that, we did have two questions come in that I feel like are a bit related to the risk factors you were talking about.
Great.
One of them is that we are seeing some pickup in corporate and consumer bankruptcies as we go back to 2022. Is there any evidence that that's having a negative impact on the corporate debt markets? So either you or Dimitri, if you want to weigh in on that with thoughts.
Yeah, I mean, defaults have been incredibly low, as reflected of what Dimitri said about spreads have been very tight. We have not had a material credit event, even going through COVID. There was an assumption of a credit event as we pulled ourselves into a manufactured recession, but we haven't seen much of that. The pockets that are making headlines, either they're very specific to one business, it could be fraud related, it could be AI related, or kind of over levered. It's certainly not systematic and broad. As we look at the consumer and the consumer balance sheet, obviously they've been a healthy spender. We talked about that today. When you start to look at aggregate savings here in the U.S., and when you include things like credit card receivables or pay now or buy now, pay later loans, it looks like a little bit more of a levered balance sheet. But corporate leverage in particular, right, is not off the charts. If we look at either just debt to equity or the interest coverage of corporate lenders, they're actually in a pretty good spot relative to history. More of the leverage has actually gone into the private market because that's where it's been, sought, and the returns have been yield. And Dimitri covered that there are pockets of potential volatility, but not material defaults. Now, defaults are a normal part of an economic cycle. They will happen and they will grow eventually. We don't know when that will occur. But today, given the spreads that Dimitri mentioned, basically the compensation for that risk it's fairly small. It's not a space that we're adding lots and lots of money to, right? We have some exposure there. But if defaults do pick up and spreads widen, that would be an area of growing interest. But it's a good question.
Yeah.
Yeah, and what I would add on there, sorry, Dimitri, just one thing on the consumer picture is we are reading and seeing headlines about credit card delinquencies and defaults rising, but you're not necessarily seeing that go to an above normal range. So the headlines are informed based on where the delinquencies were post 2020, in which case they were actually abnormally low. The defaults and delinquencies were remarkably low from 2020 through about 2023. Where we see the trends heading right now, it's just simply back to what the long-term average was. So we'll keep an eye, to the extent that that becomes a bit of a canary or something that we need to pay attention to as a yellow flag. Just remember, it's going to the long-term average. It's not necessarily above. Dimitri, it sounded like you're going to add one additional point there.
You stole it, Mr. Ramsey. So we're
I
good.
did. Good. We've
The
worked together for too long.
The second question in there, after was even with resolution of the war, infrastructure. And Chris, I know you and I have chatted quite a bit about, the fix to infrastructure is not overnight, even if the resolution is. So do you want to just address kind of what that could mean and potentially perpetuate, higher prices through lower supply?
Yeah, so that's exactly right. So our conversation has been around, well, in the slides that we shared earlier, were around the independence of the U.S. relative to other geographies and other parts of the world. But it's absolutely true that infrastructure in the Middle East has been destroyed to a large part. You have to remember, though, where a lot of that oil is going and where it's transiting. Most of the oil coming out of the Middle East is going to the east. It's not so much coming to the west, meaning that it is headed towards places like India, Japan. It's also going to China and broader Asia. That is going to have a material impact on that input cost, particularly as you think about manufacturing. So for manufacturing activity that'll happen and come out of places like China, there is an impact on the input price. So what we see happening and what we've talked about is that prices are likely biased to the upside, not specifically from oil itself, but from the flow through of everything else that's an input. Brad mentioned that it's not, the war is not simply about oil as much as that is grabbing all the headlines. There's a bunch of other chemicals, fertilizers, and production that happen. We're hearing discussion around things like nitrogen and how much of that comes from the Middle East. So it's all about the input costs, and that's what's going to bias prices to the upside. Now, as we think about portfolios, what we've talked about over the past couple of years is the inclusion of things like TIPS within a portfolio or inflation protection securities. So on the fixed income side, you can own things like TIPS, but you can also protect against higher prices through stocks, which I don't think a lot of people always quite recognize. But for the best businesses in the world, they are able to pass through higher prices. Much to our own chagrin. We don't necessarily want that to happen, but if you have pricing power, businesses will take advantage of that. So again, that infrastructure, it's going to take a while to rebuild. It's going to bias prices to the upside. We are thinking about that in the portfolio context.
Maybe in our last few minutes here, one of the things that's been coming across our desk, and I know Chris and DK, you guys have seen a lot of this, is more on the exuberant side. So I know in Q&A we went a little bit on the bear side, but some of the excitement surrounding pending IPOs, obviously AI, and whether it's Anthropic or others, but SpaceX seems to be knocking on the door, maybe the most telegraphed IPO in the last multiple decades. Chris, we've gotten a lot of questions on that front. What are your thoughts on SpaceX, maybe for a fun little close here?
Yeah, sure. So to the moon, right? No, what I would say is that we have heard from a lot of folks saying, "I'd love to access SpaceX. I'd love to be able to invest." I would tamp down enthusiasm and expectations a little bit, but I would also remind everybody in the room that about 99% of you, if not more, already own SpaceX, and I think that's a surprising fact that people don't necessarily recognize. Companies like Google invested in SpaceX a decade ago. Google also owns a stake of Anthropic. And we're not talking about insignificant stakes. In the case of Anthropic, they own 14% of that business. In the case of SpaceX, they own 5% of the entire business. And if we're looking at an IPO of $1.75 trillion, that is meaningful money that will come back to shareholders through dividends. It'll also potentially come through special one-time cash distributions, or perhaps they increase their share buybacks. So just recognize that for a lot of people, you probably have more exposure to the companies that you're wanting to get access to than you otherwise realize. But when you look at the fundamental picture, you also may want to just tamp down the enthusiasm a little bit. From what we have seen, SpaceX is currently priced at 94 times trailing 12-month earnings. And if we're talking about the S&P being expensive at 20 times, well, raise that by a factor of 5, right? And so, yes, the forward prospects could be incredible. We're talking about a total addressable market of the universe. And yeah, that sounds fantastic, doesn't it? But it's going to take a long time to get to the rest of the universe. That is not an overnight proposition. And yeah, I'll leave it there.
Fair enough. To the moon.
Yeah.
Well, look, we appreciate everyone joining. Thank you for spending an hour with us. As always, if we didn't get to any questions you want to address, feel free to follow up. We're happy to, or connect with your advisor. We're happy to get them answered. But we appreciate an hour of your time on the afternoon, and thanks for joining us. We'll see you next quarter.